This is the Everything Financial Radio Show here on the Legacy Radio Network. I'm your host, Dennis Tubbergen. We are here every week at this time. Glad you tuned in. Got a terrific show lined up for you today. We have economist and best-selling author Harry Dent on the program today. I'll be getting Mr. Dent's take on the current economy and his prediction for the financial markets. Also, I'm going to share with you some comments made this past week by Nouriel Roubini, professor of economics at New York University, and also some very interesting comments made regarding the fiscal cliff deal by former Republican presidential candidate and now retired Congressman Ron Paul. I happen to agree with what Mr. Paul said this past week, so I'm going to share that with you, and you can get your take on it. Also, I'll be talking about Japan. Is Japan the new Greece, and is the money printing game there just about over? Japan actually has higher debt levels than Greece. We'll talk about how they've been able to get away with it, but we'll also ask, is the gig about up? I also read an interesting survey about today's college freshmen. I don't think it's a very positive development. I'm going to share that with you in the last segment on today's program. Before we get to our interview with Mr. Dent, though, I do want to invite you all to get a brand new report. First week this has been offered, hot off the presses, if you will. The report is titled 2013, The Retirement Rules Have Changed. As you all know, if you're a regular listener here on the Everything Financial Radio Show, the Federal Reserve is now printing the equivalent of over $1 trillion a year. Will that result in inflation, or will the economy continue to show some signs of deflation, or both? How do you protect yourself? And interestingly, politicians and policymakers over the course of history have printed money. And the report talks about 4 different times historically that politicians have printed money and shows you what the outcome has been. Human nature, being very predictable, has today's policymakers and politicians following the same course of action that's been tried many times through history. The report gives you 4 different times that this policy has been pursued. You can get your copy of this report by visiting mybest2013.com. Those are the words MyBest followed by the numbers 2013, mybest2013.com. All you have to do is enter your name and address, and we'll mail you your copy of this free report. 2013, the retirement rules have changed. Also, the Everything Financial Radio Show is available on iTunes. It's free. Just go to the iTunes store, search under Everything Financial Radio, and you can download to your iPad any previous show or the current week's show if you'd like to listen at a later time. You can also visit everythingfinancialradio.com, and all our guest expert interviews are posted there. That, again, is everythingfinancialradio.com. I am pleased to have back on the program with me today Mr. Harry Dent. Harry Dent is an economist and author who has been a past guest here on the program. His latest book, The Great Crash Ahead, Strategies for a World Turned Upside Down, is must-reading. Harry, welcome back to the program.
Nice to be back, Dennis.
Harry, I would be remiss if I didn't ask you a question about the fiscal cliff. And given that the recent fiscal cliff deal in Washington really doesn't offer any meaningful deficit reduction, it essentially raises taxes on every working American, given that the Social Security payroll tax cut was not renewed. How does this deal, in your opinion, affect the economy moving ahead?
Well, like you say, long-term it did nothing. The payroll tax was a temporary thing anyway. They can't continue that forever. But, you know, the raising the taxes on the top 1% to 2% might raise $600 billion over the next 10 years. That's nothing. We're projecting 12 to 15 trillion in additional deficits over the next 10 years, and there was no spending cuts. Now, that battle's going to happen in February over the debt ceiling. So basically what's happened here, the Republicans worked as hard as they could to stop tax revenues from going up too much, and now Democrats are going to fight to keep spending entitlement cuts from being too much, and we're not going to get anything meaningful. We might end up getting $2 trillion in potential deficit reduction over the next 10 years when, again, deficits are slated by our estimates $1 trillion plus in good years and closer to $2 trillion in bad years off and on. You know, we're talking 12 to 15 trillion over the next 10 years. This knocking off $2 trillion is not basically fixing the problem.
Harry, I want to come back to that, but I'd like the listeners to be a bit more familiar with some of the work that you do. Your organization is a leader in demographic research as it relates to economic activity. Could you give the listeners just a brief explanation of your work?
Yeah, instead of looking at politics, which at times like this has impacts, but long-term the economy is driven by the predictable things that people do, at least in a developed country where middle class and above people have enough income to really impact the economy. We cradle to grave. We know when people enter the workforce, when they get married, spend the most money, borrow the most money, buy the most potato chips, camping equipment, invest the most money. And this caused waves of innovation, waves of inflation and disinflation, booms and busts, and then, of course, booms and busts in different sectors like housing or automobiles and things like that. And, of course, we can do this around the world, especially in developed countries. So it's kind of like a new science, and economists are not trained in this. I learned it in marketing courses and learned it in business consulting with large companies and new ventures. And basically, in today's world, especially in the last century, demographics is the biggest single driver. I mean, again, even inflation. People don't appreciate how much it costs to raise a kid and why kids are unproductive until they enter the workforce, and the cost of that versus no productivity is the biggest cause of inflation. It wasn't monetary policy that caused the highest inflation rates rising into the 1970s. It was the baby boom generation entering the workforce. Well, once they got in the workforce, then they caused this incredible boom and housing bubble and everything else. They bubbled everything because they're an abnormally large generation. Well, our news is since 2007, baby boomers are done. They've raised their kids. They bought their houses. They've spent the most they're going to spend, except for the richest people who are not far from peaking now, and they're just going to basically be slowing down until the next generation comes along. And guess what? For the first time in history, the next generation, the echo boom, is not as large in the U.S., and we already see what's happened when a smaller generation follows a larger one. You get a bubble that bursts in real estate and stocks and economic growth, and it never comes back because at some point the dying off and aging of the older generation offsets even the gains of the new generation rising. So this is a unique time in history where we've gotten so wealthy and so urban that people aren't having enough kids to sustain the future, and there's a lot of clear implications for that, near term and long term, and we look at everything, growth, different parts of the world, inflation, disinflation, deflation, aging, entitlements. Demographics is the ultimate leading indicator, and it's a real shame that economists kind of refuse to look at it just because they weren't trained in it in Yale or wherever they went.
We are chatting with Mr. Harry Dent, author of The Great Crash Ahead, Strategies for a World Turned Upside Down. Harry, in the past when you were on the program, you had forecast a major stock market decline. I'd like to ask you, is this still your view in light of the massive money printing by the Federal Reserve?
Well, not imminently. We had QE2, and that kind of brought us back up. I mean, what we see is happening over and over again is since 2007, our demographics have slowed down and will slow down for the next decade. There's nothing you can do about that. Older people just don't spend money when they don't have kids around. Our debt peaked, in the private sectors, especially in 2008, and has started to deleverage. Well, governments are stepping in and saying, hey, we're not going to let this happen this time. We're not going to let this be in 1930s. We're going to just, for every dollar the economy loses, we're going to put in $1. For every dollar a bank loses or their loan reserves get compromised, we're going to put in $1 in the system, and we're just going to keep this bubble going. And that's really incredibly irresponsible and short-sighted, but it works short-term. And so what we get is, we get stimulus every time the economy slows down, and then the economy gets a little better for about a year, and then it slows down again, and then they have to keep stimulating. That's the sign people should get. If our economy really was recovering on its own, we wouldn't have to keep it on life support, which the Fed has to do. But the real thing to look at, and this has already happened in Europe, every time they stimulate, it has less impact. Just like a drug, you have to take more and more to have less and less impact until the drug itself or the side effects kills you. So in Europe in 2012, despite massive stimulus early in the year, they fell into a recession anyway. Now, that recession would have been worse without that stimulus, but the stimulus was not enough to keep the economy and the debt problems from rolling down. I think that's what's going to happen in the U.S., but I don't think it really comes to more like around mid-year. I think right now we've just had a very strong QE3 commitment. China is looking to re-stimulate. Japan's already re-stimulated. Europe is probably going to come up with another stimulus plan. They always seem to follow us in a lag. I think the first half you kind of get some on and off strength and weakness, but you don't really get a meltdown, and the markets probably edge higher off and on. But second half, I think we do finally get to that point where the stimulus just doesn't work. And what we see in demographics is that the wealthiest families, top 10 to 20%, peak in their spending about 5 years after the average person. So demographics hit most people after 2007, but after 2012 or 13, sometime in the next year, we think the wealthiest 20% that account for about 50% of spending, they're going to tail off as well. And then who's the government going to stimulate to spend? You know, so I think the stimulus fails this year, but I would be more cautious, you know, second, third quarter forward, and not now. I don't think people should be jumping out of stocks here. I think they'll be rocky with the second cliff coming over the debt ceiling, but I don't think we don't see any signs that stocks are ready to peak for a number of months. But I do think when they do, and that's what we've watched, every 3, 4, 5 years we bubble up with all this stimulus, and then we have a big crash. So when the crashes come, they come hard and heavy. I mean, 2000, 2002, 2008, 9, people just get blindsided because markets go down a lot faster than they go up.
We are chatting with Mr. Harry Dent, and we will continue our conversation with him in the next segment when Everything Financial Radio returns here on the Legacy Radio Network. Stay with us.